Total of 10 lakh crores were wiped out from the Indian stock market in just one trading session. But should you really be worried? So chapter 1, the bloodbath. On 20th January 2026, starting 9:15, we saw a continuous down move in the Indian stock market where the indices hit a 9-month low to close the day, wiping out 10 lakh crores in a single trading session. But what can actually be the saving graces amongst all which is going on? De-dollarization is in full effect. GST cuts have been announced, interest rate cuts have been announced to boost consumption amongst the retail investors and the public of India. But amongst the continuous tariff threats from the United States, India is not bowing down. They have also announced a 30% rise in the import duty of USPs and pulses imports. And being a very prominent and an active player of the BRICS, India is boldly standing with Russia, China, and possibly the European Union to stand against the United States. When such geopolitical events unravel in front of us, there is absolute fear and uncertainty which can persist, but you have to look at the longer picture. Third chapter, which are the earnings of the company. We have seen time and again that the stock prices move in complete correlation with the earnings of a company in the longer run. For companies that have posted an earnings growth of more than 80 to 85%, the stock prices have literally crashed by 50 to 55%. In the short run, definitely it can freak someone out, but in the long run, it is just a matter of time before things start to improve again because stock prices track earnings. Chapter 4, the lions of the market. When silver and gold are fearlessly roaring against all odds, the world thinks of them as a refuge and forgets everything. They can only see the metal cycle and they only want to chase momentum. Chapter 5, the mean reversion. Now, if we zoom out a little, we can see that after COVID, the indices had a dream run where the stock market indices nearly doubled, even tripled post COVID, and the stocks went to give a return of more than 10, 12, 15 times. Now, when such things happen and when such bull rally happens in the market, it is safe to assume that some consolidation can happen in the markets, which is what mean reversion stands for. And the last, final, the most important factor, psychology. Ignoring the short term corrections, trusting the management who walks the talk, tracking the earnings, and not working with the sheep. When everyone hates on equity, that is the time to build your portfolios.